Hey everybody, welcome back to Everything Money. That was really fast. I don't know why I'm all hyped up today. I'm very excited because we're talking about Microsoft. Now, Paul, I know very little about this company. The market cap is $2 trillion. I've heard about it 1,000 times, but I'm not a specialist in this company, but you are. So welcome back to Everything Money. As always, we're here talking finances, stocks, businesses, real estate. I'm on fire today, Paul, but tell us your history with Microsoft and buying this company as a stock price, I assume.
Well, let's first look. This is the Everything Money software, which we'll get into in a little bit. You look at the stock and you go, oh my gosh, this thing is insane. It was like 15 cents in 1987. Look at it now. This is an obvious buy. Now, let's go to our little custom date range. Let's go to 12. Let's go to 1/1/1998, and then 12/31/2005. Well, look at this, guys. This is a darling of the internet age. $58. And a low of, after the tech crash, $20. But it gets even better. If you go back even 10 years, guys, it got even lower than that. It was down, at one point it was down to $13 in the down market of 2009. This is showing 24 for 2011. The reason I bring this up is the stock went from 58 to 23 before it finally went back up to, what's that today? 264. This is what happens. Microsoft is literally untouchable. Let me tell a little story here. Back in 2011, 2012, I was looking at Microsoft, selling for 7 or 8 times earnings, revenue increasing every year by 8% a year, profit increasing by 11% a year. And the thing I kept hearing everybody say was, this company is dead. And I was like, man, this company's dead? How could it be dead? The revenue and profit keeps going up. Dead means like BlackBerry. Revenue of 20 billion, revenue of 1 billion. That's dead. And it's not even dead yet. It's just having trouble. So let me tell you this fun story. I had lunch one day with this, how do I put this? Moron? Yeah, moron.
Okay.
This guy is one of the tech leaders in Ohio. Okay. Literally a tech leader. We were at lunch one day. And he said something to me like, Microsoft is dead. I go, well, I mean, it's dead, but you'd still buy it. No, I'd never buy Microsoft stock. Well, come on, not never. I mean, if you had the company, it had zero debt, it had $50 billion and $100 billion in cash, you could pay $50 billion for it, you'd buy it. No, absolutely not. I'm like, no, you're not understanding me. Zero debt, $100 billion in cash in the bank account, and you have to pay $50 billion for it, which means you could buy it, shut it down, get your $50 billion back, and have another 50 left over. No, I'd never buy it. Again, he's like, no, I understand, but tech changes so quickly. The company's dead. It's never going to go. They're going to burn through the money. I'm like, yeah, but you could buy the entire company and shut it down and get profit. Yeah, I'd never buy it. This is how stupid. I actually get upset about this.
Yes. Well,
because I get so mad because this is what everybody would look at him and say, that guy's a tech expert.
Oh, boy.
I guarantee if I go ask him now, 1, he would deny it, and 2, talk about how amazing Microsoft is, which Microsoft has made a lot of strides in the last 12 years, right?
And 3, he probably owns Microsoft.
Oh, he probably owns Microsoft. This company did change itself, but it wasn't failing back then. It was just in a little bit of it had a bad rep. That's all it was. Now the stock has skyrocketed. I was buying it, I think I started buying it 14, 15. I didn't pick the bottom, nobody will. I sold all my shares at 60, I think it was overpriced. Whoops, because now I think the stock is worth 80 to 100. Mm-hmm. So the whole point I'm trying to make, guys, is this is a company that really taught me that people's perception is their reality. And the hard part in the business world is you're sitting at lunch with somebody who's considered a tech expert, and he's not an investing expert. And he sits there and says something so bad about a company, and you look at it going, yeah, but even if you're right, how are their revenues and profit going up every single year? Mm-hmm. Even if he was, I can understand that the revenue was falling, profit was falling, like Apple did in the 90s. It's like, how do you make that argument that Apple is going to turn itself around? It was dead. You know what I mean? That was a company that was literally on the brink of bankruptcy. So, but then, by the way, ironically, the one company that has been on the brink of bankruptcy 3 times in the last few years was Tesla, which everybody's a fanboy of.
Yes.
So I bring this up as a huge example for everybody out there who doesn't get value investing. That's value investing, is having everybody tell you something that's completely, that the numbers show you are completely wrong. And it's hard to do that. It's very hard to do that, but that's what we're trying to teach here.
Do you want to look at the 8 pillars of Microsoft?
I'd love to. So I'm going to our trusty 8-pillar software.
So what we do is we use our 8-pillar analysis. You might have seen it before. If this is new to you, we want to screen this stock to see if we want to look deeper. Obviously, when it's an all-time high, Paul, I imagine you're probably not buying as a value investor right now, but we can show people why we're not buying with the numbers of the company. So go ahead, my friend.
So this is a $2 trillion company.
Good Lord.
Yeah, huge. PE is 35. That's an X. Remember, I was buying it at 7 to 8 PE.
We want this at least below 20, right, Paul?
Correct. So it's an X. But look at this profit margin, Uncle Seth. 35% with a gross margin of 68%. They do pay a dividend, 0.82%, 16 billion a year. So remember, folks, for those of you out there, the dividend has to be supported by the free cash flow. Free cash flow is used to pay dividends, buy back shares, a bunch of other things the company can do. A dividend isn't necessarily secure. Don't see a dividend and think, oh, at least I'm getting that. Make sure it's secure. Another big thing, look at their return on assets and return on invested capital. Huge numbers, well over 10%. This is huge. The market average is like 3%, I think, something like that. I'd have to look at it, but don't quote me on that one.
So your return on assets, you like around 15%, whether it's real estate. Is that?
Well, not real estate. The real estate is different. That's return on equity.
Okay.
Return on assets, it's part of the magic formula. It's not really it's going to become a factor in the 8 pillars. We're going to replace one of the pillars with more of an economic profit thing that I learned from Gary, our good friend, who's also kind of my mentor in value investing. So we're going to come talk about it, but basically it's, I want to see double digits. That's a really nice thing. Now, if it's lower, I'm fine with that. I just got to pay a discount for it.
Okay. Pillar number 3 is revenue growth over the past 5 years.
97 billion, 160 billion. That's a check mark. And look back in 2012, it was so poor at 73 billion.
Yeah, they suck. Profit growth over the past 5 years?
24 billion to 56 billion.
Yep.
Jeez.
Yeah.
Okay, shares outstanding is pillar number 5. Uh-oh, Paul. I see a frown on your face.
7.7 down to 7.54. Check.
Oh, it's down?
Of course. They're using their cash to buy back shares.
Yep.
Okay.
No, I don't think they should be doing it right now, but we won't get into that right now.
How about pillar number 6, which is the current assets they have versus the current liabilities
$165 billion in cash.
Jeez.
72 billion in current liabilities.
Wow, what about total?
175.
So it's close.
Very close.
Wow. Okay, free cash flow, the granddaddy of them all.
Now, guys, this software here that we see.
Oh, that's right, Paul. Let's
talk about the software.
Everything Money software behind Paul. If this interests you, looking at the evaluations of a company, not just the price ticker, which is what I did for so long, Paul, is like, pick a company, hope the price ticker goes up. That way I make money. If this will help you screen companies, these BS companies you hear hype people talking about, you can screen them in here and see how terrible their financials are, and you can have this software today if you
80
join.
cents per day, guys. 80 cents per day. You get all of this. You get all of our updates. You get the Discord chat with over 3,000 members in it, properly organized. Have conversations with everybody around the world about your investment ideas, about crypto if you want, whatever you want to talk about. We're creating that community. 80 cents a day. This software will be $50 a month here soon. So just don't be dumb. Don't be penny wise and dollar dumb. Go pay 80 cents a day. You're locked in at this price. As long as you buy this now, you're locked at this price. I push it hard because I really believe in it. And in fact, our Patreon, the people who actually buy the software think we don't push it hard enough. Isn't that incredible?
I've heard that, yeah.
And since we started recording this video, we've gotten 3 signups.
How wonderful.
Not because of this video, obviously, because this isn't live.
Yep. So if this interests you, you can join the Patreon. And of course, we'll get over to Trader Mo here and see if they're trading Microsoft. Totally different aspect from long-term buys.
Yep.
But in a minute, we'll go over to Mo and see what they're doing on the charts. Paul, go ahead with free cash flow, baby.
So guys, I added a line to our software to make it easy for you. I added the free cash flow line because free cash flow is cash from operations less your capital expenditures. 28.5 to 54 billion. Check mark there with an average of 34. 34 billion times 20. We picked 20 as a multiple of free cash flow for no other reason than starting somewhere. If cash flow is increasing and you pay 20 times, if cash flow over a 5-year period is increasing and you're paying 20 times that 5-year cash flow, you're probably okay. Now here's the issue.
680 million.
680 billion. The company is currently 1.95 trillion. Massively overpriced.
Yes.
I think, now, we have a stock analyzer tool, which we'll do after you see the chart from Mo, because our stock analyzer tool, which is included in that 80 cents a day software, will tell you what you need to pay based on your assumptions of the stock. So it currently is expensive according to this metric. Does that mean it's going to be expensive? No, we haven't factored in growth rates and things like that. But that's what we'll do.
Just a year ago, it was $100 cheaper than this. So we can get back to our stock analyzer here in a minute.
Yep.
Mo, what's going on with trading? Where are they in the charts? The stochastics, the candlesticks? Where are they, baby?
All-time highs.
Uh-oh.
They're trying to break through all-time highs right now. And they just keep going. They took a little bit of a breather there back about a month ago, 2 weeks ago, 3 weeks ago. But we're getting into that overbought area on the stochastic. But no problem. Just if you keep making all-time highs, just getting good green engulfing candlesticks, who knows where this thing can keep going?
Still no problem with no cookies left in the jar over there?
You know, it's not if I'm going in and I'm looking for stocks, this is my first time ever. This is not something I'm choosing because I do want to find something that's coming through the sweet spot.
Yes.
But if this is something that you own, go ahead and keep adding to it. I think it's great to keep going with this thing. Remember, tech is leading markets everywhere. So as the markets go, Microsoft's going to keep going with it. So if this market keeps going higher, Microsoft's going to be leading it.
Paul, what should we be paying for this with your assumptions?
Okay, so stock analyzer tool. What we do here is we input our stock, Microsoft. I always do a 7-year analysis. I don't know why I pick 7 years. You can do 10, you can do up to 20 years, you can do 2 years. I feel like 7 years is enough if I feel the company has potential. 7 or 10 years is how I want to hold a company and buy a company based on a good rate of return for those 7, 10 years. So then I have to sit, what is my desired annual rate of return? If you just want to match the market, it's 10%. So we're trying to figure out what is Microsoft currently worth, not what I want to pay for it. Because remember, I'm a value investor. I want to buy it for less than I think it's worth because it increases my likelihood of one, being wrong, not being wrong. And even if I am wrong, I don't lose a lot of money or if any. Or two, I want to make outsized returns. If I'm just going to try to match the market, I should just buy an ETF, right?
ETF and roll, yeah.
Right.
So PE, I think Microsoft's a big company, and even though they're doing great, right now, I still think 15 is a PE that I want to start with. Can you justify a higher one if the growth rate's high? Sure, but they're a very large company. Companies that are very large have a hard time growing. So we'll start with 15, and we'll go from there.
I'm still confused though, Paul, because Meet Kevin said Tesla with a $4 trillion market cap is going to grow at 90 PE.
Yes, well, he's stupid, and it said 70.
Oh, 70.
It's not a growth rate. It's just a multiple.
Sure, multiple.
Biggest company in the world will be a 70 PE. Sounds good.
Perfect. Okay.
All right. So now, what it does here is it shows your revenue growth, share changes, profit margin, and free cash flow as a percentage of revenue. Shows you the 1 year, 5 year, and 10 year annualized changes, and it asks for your assumptions. We're asking for 3 assumptions for each. Sounds like a lot of work. It's not. You have a low assumption, middle assumption, high assumption. It'll give you 3 values for each of those. That way you can determine where does Microsoft stand. So, in the last 10 years, they've done 9% return, 9% revenue growth, 13% over the last 5, 15% here. So let's go low and say they're going to match that 9. Let's go middle. Let's say it's 11, and let's go high and say 13. Even though they had 15% in the last year, that's probably a big year. So I'm going to assume a high level of 13, which is, by the way, 13% revenue growth for 7 years on a company of this size is aggressive.
Yeah, that's big.
Does it mean it won't happen? It is aggressive. Share change. Guys, they're buying back shares every year, right? Every year. So I would sit there and say, low assumption, negative 0.5%. High assumption, 1%. Sorry. Middle assumption, negative 1.5%. And high assumption, middle assumption, 1%. High assumption, negative 1.5%. So I'm assuming that minimum they buy back is 0.5%. Middle case, they buy about 1% a year. High case, 1.5% a year buyback. That's why it's negative, because they're reducing the number of shares. Okay. Profit margin. Guys, their profit margin has gone up as time has gone on. This is profit margin over the last 10 years, 5 years, and 1 year. And the reason being, they're doing a lot more cloud-based stuff. Cloud is very, very high margin. So I'm going to assume that their profit margin goes 28, 31, 34. I still think I won't go as high as last year, because last year was kind of a different year. I think a lot of people stayed home. There was a lot more ways to make money. They probably got more revenue in. Same thing with the revenue. That's why I didn't go as high as last year. Okay, free cash flow as a percentage of revenue. It's pretty consistent. So I'm going to go 28, 30, and 32. Now, so guys, I'm doing all this, and all I'm going to do here is click this Analyze button, and look what it does. It gives me a multiple of earnings value based on PE and a multiple of discounted cash flow value based on a multiple of free cash flow. It's giving me a low end of 128, high end of 204, low end also of 128, high of 193.
Current price is 262.
So the way I look at this tells me that even in my rosiest situation, I'm still high. Now, let's see what happens when you change a few assumptions. If you want to be aggressive, hey, 15% revenue growth in the high end, 18 multiple of earnings and profit. They buy back 2% of shares. Profit margin stays at last year's number. Free cash flow stays at last year's number. there you go.
267. It's 276.
Look, guys,
Right in the
my
sweet
whole
spot.
point is it's all assumptions. Now, me as a value investor, I want to make reasonable conservative assumptions and buy for less than my values come in at the low end. That's my goal. So I think Microsoft is too high right now. Back in the day, right now Microsoft is 265. When I was looking at Microsoft, it's like it was today selling for $60 a share, $50 a share. That's how good of a deal it was back then. The equivalent of today's stock selling at $50 or $60 a share. That's what I'm looking to do. That's all this is. This is going to tell you exactly what you need to pay based on all of your assumptions. That's it. And that's it.
Final take on Microsoft.
I just think it's expensive. Is it a company I want to own? Absolutely. But it's just too expensive. Simple and straightforward.
It's a lot of things these days. We'll wait for the
Yeah,
fall.
and guess what? This is what I love about the stock analyzer tool. It shows you the numbers. You can't sit there and a stock, any investment is the present value of all future cash flow. Now you might be sitting there, but I don't get the cash flow. Yes, you do, because the balance sheet gets better. They buy back shares. They pay down debt. They increase revenue, increase profit. They do all these things that makes the piece of the company you own worth more money. That's it.
That's our take. If this resonates with you, click on the link below to join the Patreon. 3,500 people, Paul. It's
80 cents a day.
It's amazing. You can have this software and access to us. You get access to our portfolios. You get exclusive content, live streams just for you. And our subscriber to Patreon percentage is one of the highest I've ever seen on YouTube.
We had a meeting with Patreon the other day, and I mentioned it to him, and he smiled and goes, "It's insane."
Yeah. That's because we're giving you a lot. We're giving you a lot for it, not just support. So that's our take on Microsoft. Follow the like on the way out, and we'll see you in the next video. Appreciate it.